Test 1, 2, 3. Test 1, 2, 3. Test 1, 2, 3. Good afternoon, everyone. I'm not sure if we've got. Can you send me a quick message if the audio is clear? And we're just trying to get the presentation up. For some reason, I'm unable to see the chat window here. So let me just test this. Now, in full disclosure, this is the first time that I'm using YouTube Live here. And we are going to be able to figure this out. I've just got my marketing team to check if this is working. For some reason, I'm not able to see the chat window. So I feel like I am in excommunicado. And we will be getting the audio seems to be all right. So I've got the audio check done. And now we're just going to be able to get the screen share going and get the presentation on the road here. I am, again, give me a few minutes, please. I'm unable to get the camera going, so let me just see. All right, welcome everyone. Thank you for joining me. And today we're going to be discussing Nvidia, the AI trade, and managing risk in a volatile world. Oh, I've just got a note. Perfect. Ah, there we go. I hope everyone can see me as well. My name is Suhail Ahmad, and today, we're doing our inaugural webinar at Tech Investors. So Tech Investors, is a not-for-profit initiative that I've taken built on a podcast that I started several years ago. And what I want to be able to do is be able to share some of the insights and some of the work that we do and share with the professional investment community, but make it accessible to individual investors as well. So the agenda for today is a brief introduction, just to introduce myself and what we are doing at Tech Investors, and then dive right into it. Understand the war in the financial markets, and in particular, the AI trade, Nvidia. I get questioned and asked about, I think Nvidia is the most asked company, and it's the largest weighting in the index. So what happens to Nvidia impacts all of our investments in the indices and is an important indicator of what's happening in the AI investment world. So we'll touch about Nvidia, and then we'll go into two specific companies that we've identified that demonstrate a very good, reasonable valuation and an attractive reward to risk ratio. Okay. And then what we want to be able to do is, in the last 30 minutes, open it up to the floor. Now, for some reason, I'm unable to see the chat window, so I hope you're able to see it. And if you are, maybe just do a test. And my assistant, who's supporting me as a kind of backup here on WhatsApp, will let me know if there are any messages coming up on there, because for some reason I'm not able to see the chat window, so I'm not able to assess any questions. So before I begin, I'd love to know where everybody is from, and where you're from, Canada, UK, UAE, and how you found out about the webinar. That would be really helpful. It would help our team in being able to assess and see how effective we were on the different channels. So let's get right into it. Let's talk about, and one of the things I want to be able to do is, you'll notice that I'm not going to kill you by PowerPoint. We've only got literally 5 slides, and what I want to be able to do is really go through really practical examples and not just bore you with kind of macro or technical details. And in the brief introduction to myself, I'm a tech investor and entrepreneur, and my name, as you may have noticed already, is Suhail Ahmad. I'm the founder of AIx Group, where we build AI infrastructure, particularly for the capital markets. And our goal is to help investors reduce their risk, optimize their portfolios, and generate extraordinary returns, right? And with my experience in the technology investment world spans 30 years. It's hard to believe that I made my first tech investment back in 1995 when I started university. And I think one of my first tech companies was, actually 2 of the ones that I remember don't exist anymore. It was Nortel Networks, which was a huge company in the dot-com eras, and they were actually kind of the dot-com infrastructure company. They were, building the networks, very, kind of similar to Cisco, but in a different way. And that was kind of my foray into the technology investment world. So this was just in the, when the dot-com boom and the dot-com rally was taking shape. Amazon was just being introduced. And what we wanted to be, and I've had the opportunity to live through many market cycles, right? So, we've looked at the boom and bust, the dot-com, then we had the housing crisis, then we had the social media boom. And from all of this, what we're able to see is that, the markets operate in cycles, and for us, it's really important to be able to differentiate the signals from the noise. Okay. Now, I'm a chartered investment manager. I'm a qualified financial advisor. I've represented Canada's largest financial institution, Royal Bank of Canada, along with the Royal Bank of Scotland and Barclays in the UK during my career. But at heart, I'm an entrepreneur and a maverick, right? So, I founded a dot-com back in 1997. I've been involved and founded or co-founded several fintech startups over the past 25, 27 years now. And what we realize is that, the market often operates in extremes, right? And we see that nowhere more evident than in the technology investment space, okay? So with tech investors, I started a podcast several years ago. I believe this was in 2022. When we were in lockdown, COVID lockdowns in 2022. We had a lot of time on our hands. I started a podcast on the side, and to be able to create some rationality into the meme stocks and the meme hype that was going on, and then we discontinued it. Unfortunately, we got busier. COVID lockdowns opened up. Time became much more scarce. But my goal was always to be able to share and give real practical insights to everyday investors, helping, so you don't need to have a finance degree, you don't need to have an economics degree, and helping everyone from doctors to lawyers, from plumbers to entrepreneurs, just make better investment decisions. Because I've seen too many people lose a lot of money unnecessarily, and it's just a matter of falling into the hype, FOMO, fear and greed, and simple behavioral finance challenges that we've studied in our finance programs and in the MBAs. But how can we distill that to the average investor and make sure that they don't get caught, and don't get trampled when direction changes, right? And I believe we're now in a very interesting point in the financial markets, in the tech sector as well. And I'm going to be sharing some of that. And hopefully by the end of this presentation, not only will you have two really interesting investment opportunities for you to consider, but you'll also be able to learn about investing and build a framework, an investment framework that will help you, make money in technology and make it less risky, less painful, right? And so that with that, let's get into the next part of our conversation: war and the markets. Okay, but before that, I've been reminded. Um, Disclosure: it's very important that you understand that this webinar is for educational and informational purposes only. All right, the information presented does not mean that it for you to go and buy. It's not a recommendation for you to buy or sell any securities. It's simply our insights and our research that we're sharing with you. It is not financial or investment advice. You have to do your own due diligence. All right. So with that, let's talk about briefly the impact and what's happening in the geopolitical space. Now, of course, there was always the risk, the likelihood of the U.S. and Israel attacking Iran. We had been hearing about this. We've been hearing about the buildup over the past several weeks. And when we're having these type of events or these type of situations, we build basically financial models, investment models that look into it's a combination of predictive analytics and scenario planning, right? So in our models, we had a more than 50% probability that there would be some kind of military action on Iran. Okay, now then the next question becomes, okay, what type of action is it going to be, and how prolonged is it going to be, and what are the possible scenarios that can play out? Okay, and is it for as a technology investor, do we need to, what precautions can we take in our model portfolios, and what opportunities can arise from the impact of the war? Now, during my career, we've had several kind of conflicts. We obviously recently we had the Russia-Ukraine conflict, but before then, the previous biggest conflict in the Middle East was the Gulf War in the 90s, right? When the U.S. attacked Iraq, and we had a prolonged war. What we've noticed from all these events is, although the human impact, is no doubt significant, and a lot of people are going to be suffering, and it's mostly civilians that suffer the brunt of the impact of war. overall, the financial markets tend to shrug it off, and there's the economic impact is not significant unless you have disruption or shocks to the supply chain or the energy markets, which in this case, the markets behavior with the Korean index, being a great example, dropping 12% yesterday, then it was up like 10% overnight, and now it's back down, I think, to flat, right? So you're having these huge, extreme moves in an index, right? And the underlying stocks, of course, are witnessing significant movement as well. All right. So now with this, what we are able to see is that, okay, this volatility, yes, it creates opportunity, but it also amplifies the risk, right? So position sizing, how much you've invested in a company becomes very important, okay? And the level of risk you're taking and the sectors you're exposed to becomes very important, okay? So, overall, we're not too concerned. We think, in our models, the probability is that this, the war, the activity, the attacks in the region will diminish over the next week, and we will start to see a bit more normalization. We still have an energy shock concern, but that energy shock concern is more impacted on the Asian market than the North American market. So investors in the US and Canada are going to be less impacted because the US is a net exporter of petroleum, right? As is Canada, of course. So, the impact, if I was an investor in Korea, China, in those markets, I'd have a lot more concern than for an investor in North America. Now, this will also mean that it could be a net positive for the American markets, because more money, capital flow will move away from the more economically sensitive countries into the North American markets, right? Because capital flows where there's a bit more certainty and less risk. So the risk in the Asian markets has just significantly increased with the uncertainty about oil prices and flow of energy and possible shortages. So that's my quick take on the markets. I'm also keeping an eye on the time here. So let's look at Nvidia, and what's been happening with Nvidia. I'm going to quickly go through the earnings. Now, a lot of people ask me, what happened with Nvidia's earnings? They were good numbers. The stock moved up on the first news of the earnings, and then in the following days, it gave up almost 5-7%. And yes, the Nvidia earnings were, I would say, blowout. They had $68 billion in revenue, 73% year-over-year increase, and they guided for 78 billion the next quarter, right? But unfortunately, it wasn't good enough, right? So the markets are always forward-looking, okay? And this is where a lot of investors, a lot of tech investors, get caught in this situation where they're looking at the fundamentals, and the fundamentals are good, but you have to take into consideration, are the fundamentals good enough for the expectations that have been built into the stock price? Okay, and now in fairness to Jensen and the Nvidia team, I don't know what more they could have done, right? They pretty much did everything right, but because it's priced to perfection, there's just not the investor demand is decreasing, and at the end of the day, stock prices move based on supply and demand. Okay, and so people are rotating out of Nvidia. They're realizing that the best days of Nvidia are over. It doesn't mean Nvidia is a bad business. It just means that the market perceives it to be fully priced at this, And now, if the market trends up, Nvidia will likely trend up. And actually, the market can't really trend up without Nvidia trending up because it's such a heavy weighting in the S&P 500 index, as well as in the Nasdaq 100 index, right? But I think it's hitting that ceiling, right? And the biggest challenge for Nvidia going forward is maintaining its margin. It's got a very healthy 70% plus margin, which is going to be really difficult for it to defend as as we move from to agentic AI and move from building to utilizing AI, and the shift from inference chips, which don't require as much one power, they don't require as much processing power, and Nvidia has competition that's from Google, from Broadcom, from other companies that are going to start challenging its dominance, particularly in the inference space. So there are several things that are going to be challenging for Nvidia. So and then what I tell people, I don't tell you what to do, of course. I'm not giving you investment advice or telling you what to buy or sell. But at this time, I don't own Nvidia, but I am considering buying some because it is essentially the godfather of AI, right? It's the dominant player. But I need to allocate capital as a professional investor, and yourself at home. You need to allocate capital to where you get the best risk to reward ratio. Okay, and as you can see, kind of in the chart that I've got on this screen here on the presentation, Nvidia is a very volatile company. If you look at the price of Nvidia shares over the past, let me just get my cursor on here. I hope you can see my cursor there. But so Nvidia, during the .com, it had a very similar extraordinary run up, and then it it was a kind of a blip in the .com, but in 2022 it had this huge run up, and then it pulled back, and then it's had this huge run up. So you're seeing, as I said earlier, you're starting to see stocks operate in cycles. There's just like a business has a life cycle, stocks have a life cycle. They go from growth to maybe hyper growth to becoming having less growth, to becoming stalwarts, to becoming cash cows, and during that their valuation metrics change, right? So now the second wave of AI is this transition that we're going to see from essentially the from the training of the models to the utilizing of the models, right? And the two opportunities that we see that are going to be massive are going to be, of course, physical AI, the transition from AI in software to physical AI, agentic AI, of course, and the energy infrastructure that is required to support and scale these data centers. Okay, so so let's go into the two alternative AI plays that I've got for you to consider, and I'm going to see if I can actually. Okay, I'm just to avoid any issues with the system here. I'm going to basically go into the. I'm not going to do a live screen share, but I'm just going to go into the two names that we've got here for you to consider. So the first one is Arista Networks. Now, this is a company that's, I'm going to just pull up to give you a little bit of an overview. The ticker is ANET. And the way that I would describe Arista Networks is that if Nvidia is the engine, Arista provides the high-speed highway. It provides a highway for the engine to run on. So as AI models scale, the bottleneck isn't just compute, it's how fast the data can move between those chips. Okay, and Arista Networks essentially builds the data, that Ethernet transition. Basically, because what we're having now is kind of a shift from InfiniBand toward Ethernet for the back-end AI clusters, right? So these cables that are connecting all these chips are built by Arista, and Arista is the market leader in this space. And they're currently in the position of helping their customers transition from 800 gigabyte speeds to 1.6 terabit, right? And their total addressable market is increasing. They've got the valuation now as a technology company. Their valuation is very reasonable. They're trading at a 45 times price to earnings, considering that they have a net margin of 39% and 28% year-over-year revenue growth. And if you look at the price for the company, it's been trading kind of at in a range over the past few months. So it's had really good support at the $131, and the average analyst targets are around $176. So it presents 50% upside with about 10 to 20% downside. So, and it's something that we like to identify companies that aren't in the news yet, right? Because usually what happens is when a company is in the news, the much of the news is priced into the stock, right? So we want to identify companies that people aren't talking about yet. And Arista Networks, ANET, is one that we think provides good opportunity as an AI infrastructure company, right? That's involved in the expansion and the build out of the AI data centers. The second company, we love the AI infrastructure space, and there's a lot of companies in there that we can talk about. But I wanted to kind of give you two companies from kind of two different parts of the AI ecosystem. So the second company that we like is UiPath. The ticker is PATH. And this is a company that I believe is going to benefit significantly from the second wave. Okay. As we mentioned, the first wave of AI was kind of the training models and the generative AI, the chatting. The second wave is going to be about agentic AI, where we have the AI actually doing the work. So agentic AI, if you're not familiar with this term, is basically a fancy way of saying automation, intelligent automation, right? And these agentic AI, or these agents, basically go out and do tasks that they've been trained to do. And what people are saying, and what experts, including CEOs of these major AI companies like Anthropic, are saying, is that these agents are going to take over many of the jobs, because essentially what you're doing sitting on your desk, depending on your work, if it's not physical, so let's say as an accountant, bookkeeper, paralegal, even as a investment analyst, these agents can go out and do all the work and the heavy lifting. And this is what we call the second act for AI. And UiPath is a leader in this space. Okay, so what we like is that it's recently sold off because of the software sell-off. A lot of software companies have been sold off because people fear that agentic AI is basically going to take over their business, and it will have. A lot of these businesses will be challenged. They'll have structural challenges. These software companies, because they can no longer charge per user, because or they can continue to charge per user, but there's going to be a lot less users, right? So because now you have agentic AI, one agentic AI agent can do the work of, let's say 5 employees, right? So that means you don't need 5 licenses. The company doesn't need to spend 5 licenses, right? It can only spend 1. But a lot of these companies, I think, have been unfairly punished with the software sell-off, and one of them is UiPath. I consider this now as a value play, because the valuation is very reasonable. It's not a profitable business yet; it's on the cusp of becoming profitable. but for their technology and for their ecosystem, they're trading at less than 6 times price to sales. They're sitting on a massive 1.4 billion cash reserve with zero debt. So, and they have a moat, and they've got the software infrastructure in place to be able to support the enterprise customers. Because a lot of the enterprise customers, yes, they're going to be deploying agentic AI, but they're not going to be necessarily relying on their internal teams to do this. They're going to be relying on partners like UiPath to help implement and manage this. So, we're very confident on UiPath. I think, it can easily go up 100% from this level that it's right now. I think it's trading. Let me just have a quick look. I think it was trading around $11, $12. The average analyst price target is around $16. Our price target is actually around $20. So we think that's, it provides a very good risk to reward ratio. The downside we feel is limited, supported by its positive cash flow and the cash reserves, and the upside is very strong. So those are the two companies that I wanted to give you as an alternative to Nvidia. If you're looking at something that is a little bit less risky, a little bit less volatile, and perhaps is primed to move as the markets start to recover. So now for the last part, thank you so much for staying with us for the the current. We were able to complete the webinar within the 30 minutes or so, give or take. A little bit of a hiccup early on. But now I wanted to open up to any questions that you may have. Unfortunately, I can't see the chat window, but my team can send me any messages that have been shared. But I did have a few people that had questions. They weren't able to attend. Now, we did try to time the webinar to make it easy for people from across the world to attend. So my friends in Vancouver and Silicon Valley, they're looking at a 4 a.m., 4:30 a.m. right now. So many of them I'm sure, are still in bed or getting ready for sahur. But we were able to get some questions in advance, and some companies that people wanted me to talk about. So if there's no questions from the live webinar, I will touch upon 3 companies here that I have, and I'll just give you a little bit of an oversight on that. And then please, in the comments section below, we will share the a registration link to Tech Investors. And what you can do is that if you register, then you're able to get a summary of this webinar along with a summary of the companies that we discussed, and hopefully that will be a benefit for you. And of course, if you haven't subscribed to Tech Investors yet, please do so and turn your notifications on. We want to be able to do this on a regular basis. I've been pushed to do this more regularly and not be so selfish with my knowledge and our expertise in the space. So I want to share the wealth and get everyone to benefit, right? So we've got one comment question, but let me just address the 3 companies first that we had from our friends that couldn't attend the webinar. So one question was on the energy prices and oil and gas. Okay. So, again, our expertise is primarily on the technology side, but we do build models for commodities, and we look at the impact of commodities, and we have to do. There's no way we can be immune as a tech investor from what's happening in the energy or the commodity markets, because we need copper, we need silver, we need platinum, palladium. We need all these commodities to build a lot of this high tech particularly as we move into physical AI. Okay, but when it comes to energy, what we feel is that energy has already priced in the war. So I had some energy stocks which I sold actually yesterday or the day before on the uptick, because remember the market is forward looking. So oil jumped to I think 88, a barrel. I think it can maybe go up to 100 if there's another significant event in the Gulf. But I think now the market has pretty much priced in a short to medium war. They've even priced in the Strait of Hormuz staying closed for a couple of weeks. And it's particularly the North American market, the investors are not as concerned because they are not energy dependent on the Gulf, right? The concern is much more for the Asian economies and even for the Gulf economies because they generate the majority of their revenue from the sale of oil and gas. So if they're not able to sell, that's going to put pressure on them. So I would not be buying energy stocks at this time, but if there is a sell-off, I would maybe consider adding some. But again, we look at it from a risk to reward ratio. I think the AI trade and the sell-off in some of the software companies represents a much greater opportunity than energy at this stage. Okay, so that's my energy. And then I had a question on, let me just pull that up, on some of the high flyer stocks, which such as Rocket Lab. Okay, this is the ticker is RKLB. So Rocket Lab is essentially a competitor to SpaceX. Okay, SpaceX is Elon Musk's company, and they're going public pretty much this summer, right? So now, full disclosure, I do own some Rocket Lab, and it's been great. It's been a great stock. It's been up, I believe, even from this year it's flat, but over the past year it's up 278%. But what it's been doing, I think, is consolidating over the past little while. So if I wanted to allocate, what I allocate to Rocket Lab at this time, I think I would maybe increase my position. The reason being, the SpaceX IPO is going to be a great catalyst, is going to give a lot of awareness to other space companies that are publicly listed. And the only kind of comparison or the company that's closest to SpaceX is Rocket Labs, right? So I think, with the hype, with the SpaceX IPO, they will gain momentum. The share price is around $72, up from, just $15 last year at this time, right? And but it had a high of about $100. I believe if the market rallies, the SpaceX hype shows, this will, go back. It will go above $100 a share. And again, this is a very volatile, high risk, so it should be a relatively small portion of your portfolio if you are considering it. All right. And the third company that they wanted me to talk about is on the cybersecurity sector, and particularly the companies CrowdStrike and Palo Alto Networks. So I own. Let me give the tickers. CrowdStrike is CRWD. Palo Alto Networks is PNW. I don't own CrowdStrike, but I do own Palo Alto Networks because I just think it's very reasonably priced for where it is right now. And again, it's had the cybersecurity sector has also strangely had a sell-off with the software sector, which didn't really make any sense because with AI, particularly with agentic AI, the need for cybersecurity is going to be greater, not less. But it is what it is, and Palo Alto was, I believe, trading at. Let me have a look. So it was trading at like $225 just in October, and it fell to $140. It's around $159, so it's bounced a little bit. So I bought it actually just recently, around the $150 mark. So I believe, again, with all of these companies, you never have to rush into them, right? So, but I believe the worst is over. I would let it consolidate a little bit more. We are a little bit more active investors in the sense that we will rotate our positions on a weekly or a monthly basis, whereas most investors, don't need to do that. So when I'm speaking to our institutional investors and individual investors, their holding period should be 3 to 6 months, at least 3 months till the next earnings cycle, right? Because companies report every 3 months, and their stock mood and the stock valuations and the metrics and the perception changes every 3 months. Okay, so we usually hold a stock on a quarter to. So when we invest in a company, we're looking at its risk reward over the next 3 months. And then, of course, over the long term, the company has to have good prospects. So that's my take on cybersecurity. And now I'll get to the message in the chat. Thank you so much for waiting. And what do you think of the huge rally in precious metals, silver and platinum recently? Do you think it's because of the increase in demand due to AI or something else, i.e. speculation? A great question. I think, the rally in gold I can understand. And of course, silver is talked about as the poor man's gold, right? And silver usually trades, has higher volatility and trades in more extremes with gold. But I believe in silver, gold, I think we have because, we have a debt crisis underneath the financial markets, and central banks have been accumulating gold, and that's driving demand. And of course, the uncertainty drives demand. Silver, I think, got into a little bit more of a speculative fervor. There is some demand from the technology and from the AI rollout, because, of course, with physical AI, we need more metals. But silver, I think the critical metals, are more in demand, and some of the companies in the critical metal space, I think, have a lot more leverage because the supply is weak or is pretty much in China, and so the mines that are being built in the US and Europe, those companies may have a lot more leverage in terms of pricing and growth. But silver and gold, gold I do like. I don't personally own much gold or silver at this time. Actually, I did end up selling a lot of the gold last year, so I missed out on the recent rally. But again, I think gold and silver particularly, I'd be cautious because it is, I think, to a certain degree, at one point it became like a meme stock. Everybody on on X and some of the social media channels, they're like, silver to 1,000 and all this kind of stuff. So whenever you see any company, any commodity or anything being talked about, strongly and ferociously on social media, that's usually a signal of the top. And it usually means that, it's become a speculative asset. We like to invest in assets that nobody's talking about. We like to invest in assets that aren't in the headline, because we want to be there before it gets into the headline. The famous saying from my greatest of all time hockey player, Wayne Gretzky, go where the puck is going, not where the puck is, right? So gold and silver, I think, gold particularly, I think will continue to do okay. It will continue to grow, maybe a 10-20% appreciation. Silver, I think, is going to be volatile, but will continue to grow. But again, they are also inversely correlated with the US dollar. So I believe the current war may actually boost the US dollar. We've already seen the US dollar strengthening, because remember, it's all relative. So the US dollar relative to now the Chinese economy or the European economy is going to do better because Europe and Asia have a lot more to lose if the Strait of Hormuz does not open, right? And the investor, and the economy will suffer. So the U.S. and the U.S. dollar is in a relatively good position. And it's sad to say, but this war, I think, will likely be net neutral for the U.S. They're not going to really see the impact of it. The impact is, of course, going to be the region, the Gulf region, that's in the crossfires of this war, and the Asian economies, and to a lesser degree the European economies, because expect gas prices to go up across Europe. So I hope that answers your question. And but in particular, in terms of looking at metals and the supply chain for the AI infrastructure, I think that is something that we're looking at. And perhaps in one of the following webinars, we'll talk about the supply chain, the AI infrastructure supply chain, and where there are some opportunities, and those opportunities are created because of bottlenecks in the supply chain. So everybody realize that, okay, well, we've got the chips, but the chips need cooling, the chips need networking, the chips need X, Y, and Z, right? So that's going to be, and we've already seen a lot of money flow into those sectors, right? So now we'll do a follow-up webinar on that as well. And what are my views on? So I've got another question. What are my views on Ethernet? Not Ethernet, Ethereum. All right. So you'll notice in the last slide here, I made a little, a joke on my friends in crypto. And so crypto is something that we don't actively invest in. We do look at the ETFs from time to time, and Ethereum and Bitcoin. Ethereum, we think that it's Ethereum and Bitcoin both. We think are like cyclical. It's very difficult for us to, because there's no fundamentals, there's no cash flows, there's no market sizing, there's no way for us to determine their valuation, right? So it's purely based on supply demand of the participants in the market, right? There's no fundamentals in crypto that we can assess it on. Now, the recent, yesterday, crypto had a huge move, and that was, I think, had to do with a lot of the good news or regulatory good news out of the U.S. And so with Ethereum, Ethereum, I think with Bitcoin, they may have bottomed out in the short term, so we could see a rally, because we do actually track some of the companies that are involved in the space. So we do look at Coinbase, we do look at, on the Ethereum side, Bitmine, BMNR, which is basically Ethereum treasury company. We do monitor, and I can actually have a quick look at our models. What are they indicating for Bitmine? And so that could be a better way to play the Ethereum market, because Bitmine, basically, think of it like a holding company, right? It's a holding company that's in the business of holding and staking Ethereum, right? So the reason that Bitmine could be a little bit better play is because it basically gives you exposure to Ethereum, but Bitmine is trading actually at a discount to its book value, and it's about a 10 to 20% discount to its tangible book value. So meaning that it holds, as an example, I don't know exactly how much Bitcoin it holds currently, but I think it's around $25 or so, $25, $27 of Bitcoin it holds per share. But its stock price is trading at $21, right? So if Ethereum was to continue to increase in value and trend up, then you would expect investors to bid up Bitmine shares and hopefully close that gap. So that gap between the price to book gives you a little bit of a buffer, right? It doesn't mean that Bitcoin won't fall in price if Ethereum falls in price, because it does trade as a derivative of Ethereum, but it gives you a little bit of cushion, right? And and when we do invest in crypto, we invest it through the companies. So Coinbase, as an example, had a huge run up. So Coinbase, maybe we can talk about Coinbase next and some of the crypto stocks. I'm just making a note here. Because we look at the companies involved in the sector. So, so some of the companies that we like that are in the sector, Galaxy Digital, GLXY, has been one of my favorites. We were one of the first investors in the company back when it was like trading at $1 per share, and I think now it's trading somewhere around $30 Canadian. And Coinbase is a great proxy and a great way to invest in crypto without necessarily having to invest in Bitcoin or Ethereum. So I hope that helps your question. We've got another question that will Saudi and Japan building their own sovereign AI clusters? Is that revenue actually as stable as regular enterprise money, or do the geopolitical strings make it more difficult, I believe, or make the stocks a riskier bet? Now, we don't currently in our models or in our data set, we don't have any companies from the Gulf region. So our data set primarily comprises of AI and technology companies in the US, Canada, Europe, Korea, Japan, and China. So with the sovereign AI cluster, now sovereign AI is going to be huge, because countries need to have their data within their geographic locations and under their control and protection. So, I think if I understand the question correctly, the revenue from the clusters will be derived from the companies within the countries, right? So for example, if with the Humane project in Saudi Arabia, that AI cluster, that sovereign AI project is going to basically help the companies within the Saudi economy and become AI ready and to be able to scale and implement, build AI models and run inference and run the whole the process of delivering AI solutions within the country. Whereas right now, much of the training is being done in the US, much of the inference is being done in the US, and the chips and the hardware that is running all this is being hosted and being built. The infrastructure is being built in the US. So it will, investing in, I'm not sure how we can invest directly in some of these sovereign AI clusters, but the beneficiaries of these AI clusters are still going to be the major AI infrastructure companies in the US, right? Or even in the UK, ARM, ARM, and of course Nvidia and AMD, and depending on who they are working with, because they're going to need a whole kind of a portfolio approach to building these clusters. They want to not be dependent on one technology or one company, and the geopolitical situation right now doesn't necessarily impact the AI infrastructure companies based in the US. I think they will impact more so any AI infrastructure companies that are in the local markets in Saudi and Japan, as an example, right? And so I hope that answers your question. And thank you, everyone. We've got 5 more minutes. If any last final question, I welcome any questions. And please do, if you haven't, do subscribe to Tech Investors and share it with your friends. And we hope that it will be a benefit to you and will help you become a more informed investor. And without any further questions, I'm just waiting for my team to confirm no additional questions. I will take your leave. And Okay. They say no. One more question. Okay. Sorry. There was one follow-up question, I believe, um, from Karthik. Okay. Thank you, Karthik. What are your views on the massive confusion due to Bloomberg about Iranian deputy foreign minister's word? Okay. I'm sorry. I'm not familiar with this statement, or perhaps uh, if this was this morning, I haven't come across it. So unless you can share with me exactly what was said by the foreign minister, unfortunately, I'm not able to answer that question for you. And again, I think yeah, the conflict and this geopolitical situation will continue to be volatile for at least another 1 or 2 weeks. But then at the end, in terms of what are different scenarios that we're looking at for this U.S. Israel attack on Iran, and this and now um, the last I heard was that there could be a ground incursion from the north, and so again, all of this is going to create volatility, and most of it is going to be noise. Because at the end of the day, as an investor, you have to look at the companies within your portfolio, and you have to look at the impact that these companies may have, that this war could have on these companies. And the easiest way to look at this is by seeing what sector they are involved in. Like obviously, a lot of consumer stocks, consumer discretionary stocks, sold off on this news because they know that if oil prices go up, costs for the average consumer goes up, and they're not going to be spending as much on their next car, as an example, right? So these kind of things. So okay, so I've just got an update. I'm sorry, I don't have the chat working on my screen, so I've got the team kind of relaying this to me. So thanks for clarifying, Karthik. So they basically quoted a previous statement of peace by Iran as current news. Okay, so now of course, if we have peace, and if Iran says we want to have peace, and we will agree to all the terms and conditions that the U.S. is imposing, then oil prices will fall, right, and the markets will rally. Like it will be a positive because it removes that uncertainty. But as I'm seeing right now, I've just opened our screen, our dashboard. Oil prices are up about 2%. Gold is flat. Silver is up about 1%. Crypto is flat. The futures in the equity market are flat. Korea actually closed down 2%. And China was down 1%. So the market is still not, I think, satisfied. So the market seems to be dismissing that, and this is one of the things that we're going to have to unfortunately put up with, this constant noise, and some of this noise obviously impacting the markets, and for us to just remain vigilant and do make sure that our portfolio doesn't have too much concentration in any one investment. And if we are trying to invest in the recovery, I always, advise. Well, I shouldn't use the word advice. I always encourage investors to not dollar cost average down, but to dollar cost average up. Right. So Palo Alto, the cybersecurity company that I mentioned, is a great example. So we took a position. We wait for the company to stabilize or from the selling to abate, because we'd rather dollar cost average up than dollar cost average down. And if you think about it, you actually have the net effect, but less risk on the downside, because you're wanting to make sure that the selling the majority of the selling has abated, and all the investors that want out are out. So because at the end of the day, it's supply and demand. So you have to let that excess supply come through the system, and then you wait for the demand to improve, which will usually correspond to the next earnings cycle, or as we move towards the next earnings. And then the next earnings will either verify our thesis, support, or negate our thesis, and the company will fall and not recover, or it will continue to recover, right? So I'll close off with that. Thank you so much for everyone that attended and for your messages, and we look forward to doing this on a more regular basis. So do subscribe and turn notifications on, and thank you. Stay safe, and God bless.